Yeah, thank you very much, Alex, for the invitation. This is a paper that I think we wrote maybe about a year ago, and then obviously then continue improving and expanding, adjusting. But interestingly enough, after writing the paper, we then also, and so the paper, as you will see, proposes a new AMM design that solves two of the most important, let's say, important problems with the current AMM design. And then we actually did it. So we launched at Cal Protocol a new AMM based on this research. And so if time allows, at the end of my presentation, I'll spend maybe 10 minutes to discuss a bit like the transition from research to actually a new product, which was an interesting experience for me since it was the first time it has happened. I spent all my career in academia until about a year ago when I changed, I was hired by Cal Protocol to do research there. So it was the first time something like this happened to me. Okay. Now, just as a bit of a motivation, right? Currently, I think the main blockchain applications currently is finance. Okay. And we have all this mechanism to exchange financial assets on chain that revolve around AMMs, where AMMs are smart contracts, are like pieces of software that exist on the blockchain and in a very mechanical, simple way allow people to exchange any blockchain-based asset. I mean, in theory, any asset that exists in blockchain form with another asset that exists in blockchain form. And currently, I think the daily volume of exchanges on these financial markets is between 4 to 5 billion daily. And just kind of to give you a frame of reference, okay, this is because I'm based in Paris, but it's like same trading volume as something like the Paris Stock Exchange. Okay, so let's give you a sense of how, so not gigantic, but not even negligible. And of course, one of the reasons why all the discussion around this new financial market is relevant is that many people expect more and more of the traditional financial system to move on chain, in which case more and more of traditional assets will be exchanged using those mechanisms, and therefore studying them, understanding them, proposing better mechanism becomes important also to the traditional financial sector. Okay. Now, there is a dominant design for this on-chain market, financial market, which is that of the constant function automated market maker. But as I will explain in my introduction, this design has two main problems. One, it exposes traders to sandwich attack. You might already know what those are, but I'll just briefly explain it in a second. But just to note for the moment that they cost traders about 500K a day just on Ethereum. Okay, this is about I think 3 basis points. Yeah, something like that. And then the other one, which is a more recent realization, is that from the point of view of liquidity provider, a constant function AMM, I can say they generate what is called loss versus rebalancing, or LVR or LVR, which is essentially a profit that arbitrageurs can extract from liquidity providers when rebalancing the AMM to the new correct prices. And again, I'll explain more in detail later, but for the moment, I just know that we estimate in the paper that lever constitute a cost to liquidity provider of about 5 to 7% a year. Like you can think of it as a tax. And this 5 to 7% is really a lower bound because it is computed looking at Ethereum and BTC, which are among the least volatile tokens. So if you LP on more volatile token pairs, you experience even higher lever. So the tax you are exposed to is even higher. And also, if you concentrate liquidity, this tax is even higher. So in some sense, this 5 to 7 is a bit of a lower bound, which is already a gigantic number in my view, as in terms of like how inefficient are those mechanisms. Which, by the way, might explain why, for the moment, even for blockchain-based assets, off-chain venue are way more used than on-chain venue. So like another interesting observation. And the second interesting observation is that you might have heard the term MEV, like maximal extractable value, the process of extracting profits by rearranging transaction, and all the negative consequences of MEV, and from the point of view of the blockchain itself. turns out that sandwich attack and loss versus rebalancing constitute about 95% of MEV or more. So in some sense, the way AMM designed have important implication in the sense of they create systemic problems at the blockchain level. Okay, this is also another reason why it's important to study AMM and try to solve those problems. Okay, so this is a starting point, and what we do in this paper, we introduce a new type of AMM that solves both problems. We call them the function maximizing AMM. Of course, I'll explain in a second what it is. And then if time allows, toward the end, I may move to actually use a different slide, because now we'll switch from research to practice, and discuss a little bit how we went from this theoretical design to an actually AMM, which already exists, was launched in August. And it's kind of the first implementation of this function maximizing AMM. Right. So as a mean of introduction, I'm sure you already have seen this slide, but kind of let me anyway start from this. How do constant product automated market maker work currently? Okay. Now, the way they work is very simple. And actually, this is part of the beauty of this mechanism, because as you probably know, in theory, you can run any application you want on a blockchain, like it's close to Turing complete. But in practice, computation is very costly on the blockchain. So in some sense, one of the reasons why this mechanism became very widespread is that these automated market makers are very simple, okay? And in particular, what is the specific rule they follow? Well, an AMM is a smart contract that is defined by two things. One is called the state of the AMM. And in this example that I have here, the state is simply how many ETH are sitting in the smart contract and how many USDCs are sitting in the smart contract on the graph, big X and big Y. And then the second element is what is called an invariant function, which for the moment, let's think about it as simply this blue curve, okay? So we have the states and the blue curve. And the market maker, the AMM is simply follows the simple rule that says, I am willing to accept a trade if and only if I am going to stay on the blue curve after the trade. So that if I accept the trade, my state moves, but remains on the blue line. So in particular, let's say this is an example of someone showing up and proposing to the AMM, hey, I want to buy from you a small x of ETH, but I'm going to give you small y of USDC. And the AMM computes, well, okay, if I accept the trade, then of course, after the trade, my state on the ETH side is going to be big X minus small x, but on the USD side, I'm going to have big Y plus Y. Computes, and then ask, okay, am I going to still be on the blue curve? The answer is yes, like in this example, the AMM is willing to trade, is happy to trade, okay? Note that if you, another interesting observation here is that, okay, in this example, the AMM wants to trade, accepts the trade, and you can also observe on the graph the price of this trade, because of course, the guy receive a small x of ETH, pays small y, so the average price of the trade is just y over x, but this rise over run is just the slope, actually, minus the slope that connects the starting state with the arriving state. So kind of interesting visualization of the price as well. And for what I'm going to discuss later, note that you can also introduce the notion of marginal price, or in particular, what I'm going to need is going to be the marginal price after the trade, which essentially means, okay, someone showed up and bought small x from the AMM. Now, what would be the price if someone else would show up after the first guy and want to buy a very small amount of ETH, okay? So a very arbitrary small trade, okay? So this will be the P prime of X in the graph. So the P prime, marginal price, following the larger trade X, okay? And again, what will be important for later is that the two are different. So by design, those two objects are different. So if you trade at a given price, then the marginal price on the AMM will be different from the price at which you traded. Okay. This probably, I assume some other speakers before me already discussed this stuff. And this is just the mathematical formalization that I will also use later. A custom function AMM is characterized by the reserves, X and Y, and an invariant function, a function that takes two numbers and spits out one number, okay, from the Cartesian product of R to R, such that if there is a swap proposed, and this again, I'm sticking with the example of ETH and USDC, well, we want to purchase small x in exchange for small y, the AMM accepts if and only if the state after the swap is executed. So the value of the invariant function, the value of the invariant function after the swap is executed equal the value of the invariant function before the swap is executed. So then he's happy to trade. The most common invariant function is the product, okay? And if you go through the math, it's not complicated, but it's a bit tedious, so I'm just gonna write it down. If you have a constant function AMM where the function is the product, you can write like a simple pricing function that tells you what price you need to pay if you want to buy or sell, because the small x could be negative, a certain amount of asset from the AMM. And it's just this formula over here. And also, importantly for what I'm going to discuss later, why constant function AMM? I said, okay, one of the motivation is that you need a simple rule. Of course, that doesn't quite explain why this specific simple rule, like the set of simple rule, is pretty wide. It turns out this specific rule is important because it satisfies path independence, okay? Now, what does it mean, path independence? Path independence essentially is the property that said that if I have one trade to execute, say I want to buy one ETH from my AMM, I should have no incentive to split this trade into smaller chunks, okay? I should have no benefit from like sending 10 trades of 0.1 ETH, for example, okay? Now, this is important because obviously if an AMM does not satisfy this property, typically it can be exploited by buying and selling, splitting trades, or doing strange things. So it's important that the AMM satisfy this property. And it turns out that to satisfy this property, the AMM must have a constant function. And the intuition here is that, I mean, in the end of the day, if you are moving along a curve, all that matters is the total distance that you travel, and whether you want to do like this one big trade where the guy buys small x, or two smaller trades where x half each time, or whatever. At the end of the day, each time you are moving along the curve and you reach the same state in the end, starting from the same state, we can similarly look at the average price that you paid for the total that you exchanged, and it's always going to be the same whether you do it in one go or multiple amounts. So moving along the curve turns out to be a necessary condition for it's a sufficient condition for satisfying this property of path independence, which then guarantees the AMM cannot be exploited by splitting trades or buying and then simultaneously selling on things like this. And final observation, note that if you have a sequence of trades on the same block reaching the AMM, these trades will pay different prices depending on how they are ordered, because each trade will move the state of the AMM. And then, of course, the next guy will face a price that won't be the same as the first guy. All right. So as I said, problem number one with constant function AMMs is that they leak value to arbitrageur. So arbitrageur can earn profit by trading with AMM. And okay, a bit confusingly in the literature, these are sometimes called LVR or loss versus rebalancing. Sometimes it's called arbitrage profits. But okay, the concept is, so for our purposes, the concept is the same. Now, the simplest possible case where one can illustrate how arbitrageur can extract profit from the AMM is by imagining that this AMM that I have on chain exists next to a much more liquid trading venue like Binance. And then, okay, again, for simplicity, let's say that the price is really determined on Binance, okay? And at the beginning, the price on Binance is P prime and everything is in equilibrium. And so this P prime is also equal to the AMM marginal price, okay? Which is exactly the tangent. Okay, I didn't draw here the state of the AMM, but the state of the AMM is essentially the reserves corresponding to the tangency point here of the line with slope minus p prime and the invariant curve. Then something happened. Okay, something happened that makes the price of ETH change on Binance. And in the example, let's say it increases to P double prime. Now, obviously, Arbitrageurs will come and trade on the AMM, so to bring its marginal price also in line with that of Binance. So someone will come and trade on the AMM so that in the end of the day, the marginal price of the AMM is also P prime. But the important observation is that in order, so the guy who does the trade that brings the marginal price on the AMM from P prime to P double prime pays P of X drawn here, which is less than P double prime, okay? Because actually the price at which the new correct price is P double prime, but the AMM obviously has no way of knowing. So it is still willing to trade at an outdated price, let's say, kind of the intuition. And this can be exploited by Arbitrageurs. That extract profit from the liquidity provider that essentially are selling too low in a moment where the new correct price became P double prime. Okay, so this is a profit to Arbitrageurs and a loss to liquidity providers. Is this clear? There are questions?
Question, just your reference to equilibrium or correct price, who determines that? By what? Yeah,
so in this is illustrative example, right? And the assumption is that there is a very large, very liquid market which is unmodeled here, it just exists, where the price is determined. This is where the price, we observe it. And then we have a local AMM, okay, which is much smaller, that here is just sort of being arbitraged by Arbitrageurs who can trade both in this much bigger trading venue and the local market. So then how in this bigger market prices are determined, it's not relevant in this example, and I think it won't really be relevant for the theoretical model either. So it exists. There is some correct price determined in an external venue. Right. So the important aspect is that the mechanics by which Arbitrageurs trade on both venue and brings the local AMM price in line with the external venue.
I have a clarifying question.
Sure.
I think what you just described, like the price change from P prime to P double prime, this would be more in line with impermanent loss.
Okay.
Consider lever will be like maybe one more stage, and then you have this path dependent of how you go from P prime to P double prime, go to P triple prime, and then how you can rebalance at P prime, something like that.
So lever and impermanent loss are not the same. Okay. And I think this probably will become more clear when I introduce this new mechanism that doesn't suffer lever. But the intuition is going to be that if even an AMM that doesn't suffer lever, the AMM still trades. So it's going to sell and buy. You are not going to end up with the same, because impermanent loss, okay. So I don't know. If you don't know it, you might not. But the point is that there is this older, people had this intuition that you might lose money by LPing in an AMM for a long time. But until the famous lever paper, there was no real kind of, there was no, the conceptual framework to talk about this potential losses was a bit like not super formal and not super clear. And people will typically resort to comparing the value of a liquidity position in AMM to an alternative in which you just took the two assets and held them outside of the AMM, which is both conflating two things, which is what happened if I trade versus not trading. But then the more relevant question is what happened by trading at the incorrect price versus trading at the correct price. Lever zooms in into the fact that the AMM is trading at the incorrect price, right? But it is still trading. So the benchmark here is not what happens if I don't trade. By the way, I have wrote a kind of a short research notes you can find on Twitter and then link to the forum post which does a more thorough analysis of the relationship between impermanent loss and lever. Turns out that if you think prices are Brownian motions, okay, or anyway, if you think prices are martingales, then solving lever also solves impermanent loss in expectation, okay? So 0 impermanent loss plus some noise. So the two are related, okay, but it's a bit subtle, and you have to, they're not the same, but they're related, and you have to do some math to show how one relates to the other.
So what this is saying seems, and by the way, I am the computer scientist on this call,
okay.
not an economist, so I will ask all the stupid questions. So this seems to be saying something rather, I don't know how to say it, but rather idiotic. Like, suppose you had in the traditional financial world, the Chicago exchange and the New York Stock Exchange operating completely autonomously. Each one sets their price completely unrelated to the other. And, you know, some assets became more in demand on New York Stock Exchange. You know, the price went up there. And there was no way, absolutely no mechanism to tell the Chicago market operators, look, this asset is now in high demand. Raise your price before arbitrageurs will take advantage of it. The only way to do it is for somebody to take a loss, you know, existing. So this has nothing to do with complex liquidity provider analysis or anything. It just says there's no way to update the price without somebody actually going through the process of losing and then adjusting the market to demand, right? So on an AMM, there is no way to update the price. There is no way to come externally and say, look, the price has changed. Somebody will have to suffer that.
Yes.
But it's ridiculous. Like I said, it's like Chicago Exchange would operate in a void, not get any information from the real world. And, you know, of course, anyone with standing orders, standing positions, you know, in Chicago will lose.
Let me just say, so you are 100% correct that there is a strong, this is a kind of a perhaps new version of an old problem, which is exactly the fact that in traditional financial market, which are more order book, based on order book, you know, when the prices on different venue change, liquidity provider, they can remove their liquidity if they want, but typically high frequency trader, arbitrageurs are faster, and they are able to, like, this is called sniping stale quotes. So essentially you find liquidity provided on the wrong side, because price moves some liquidity and ends up being placed on the wrong side of the order book, and high frequency trader can make a profit out of it. So in some sense, this is the AMM / blockchain / DeFi equivalent of that problem. And
it's worse because you don't even have to be quick. If the price has changed,
you have to be quick in a different way. Like you have to bribe your way to the top of the block. So it's not speed, but how much you pay the block builder. Because of course our arbitrageur can do the same, right? So there is a competition there. But anyway, but the point, and okay, there is okay. So you are actually bringing up all the finance literature on this topic, because there has been a lot of research and proposals on how to solve this problem on traditional financial market. Because what is the problem there? If I'm a liquidity provider and I know that as soon as the price moves, some high frequency traders are gonna kind of exploit me, I'm gonna put liquidity wider, and this ends up to be a cost for regular traders because they're facing a larger spread. And the solution proposed in the traditional financial, so in the literature solution for this traditional financial market is that of batching, okay? So organize markets instead of like continuous time by frequent batch auctions. This is Eric Budish and company paper. Now, the point of our paper is exactly showing that the same solution can be adapted, okay? It has to be adapted to the context of AMMs and blockchain DeFi, right? So that's kind of...
Okay.
Yes. Okay. So this is lever. Okay. Another thing that I won't have too much time to discuss, but a pretty obvious defensive mechanism here are fees. Because fees here will mean that now if I want to buy something, It's not enough to stay on the same curve, but there's going to be like a fixed percentage fee. That means that I can only trade if I provide some percentage more than simply staying on the same curve. And there is a whole line of research that try to kind of mitigate the problem of lever by playing around with setting, for example, dynamic fees, fees that adjust based on volatility. I mean, some logic, and it's all very interesting and very good. But however, in some sense, this is a flawed design, the one of constant function, to which you can patch in some way by playing around with the fees, but it's still not the ideal starting point. Okay, then the second problem that I need to be mindful of time, that constant function AMM face is that of sandwich attacks. Again, I don't have time to go into the whole theory, but let me just say that on the blockchain, the reordering of transaction is possible. In fact, this is quite fundamental in the concept of blockchain. These are asynchronous systems. There is no shared clock that people can use, which also means that which transaction came in first or second there's no concept of that. So the reordering of transaction is left to currently on Ethereum. They are delegated to block builders. And if you pay block builders, they're going to rearrange the transaction the way you want, in some sense. So it's money can be manipulated by bribing the block builder. And also the fact number two is that by default, pending transactions are public. Okay, you can change this default. There are ways to send transaction privately to builders, but let's say the default on Ethereum is full publicity. So then what happens is that if someone sends a transaction to purchase a certain amount of ETH from an AMM, so say I look at the blockchain, I see, oh, I could get my ETH for this price on this AMM. I click buy, so I send my transaction. Turns out someone can see that and place a transaction before mine that also buys ETH. So then I get to pay more than what I was expecting. And then the attacker can place a background transaction after mine where they then sell the ETH that they just bought just after me. So essentially from their point of view, they bought ETH cheaply and then they sold them more expensive. And the delta in price comes from the fact that the victim transaction is in between the buy and sell of the attacker. Okay, but this comes at the cost of the victim because the victim thought was paying something and ends up paying more, which this more is the profit for the attacker. Okay, this is perhaps not sufficient if you don't know anything, but let me just state it this way. Okay, so then what we do in this paper, we propose a model in which AMM's trades are first batched. Okay, and batching is the key step here. What does it mean? Essentially, there is a time period in which the batch is open. You can think about the period in between two blocks, okay, where a batch operator collects those trades. Those are trade intents, okay, well, for reasons that, okay, if you want, we can discuss, but if you don't, we can skip. And once you have your batch, you can settle the trade as much as possible in a peer-to-peer way. So maybe I want to sell, you want to buy, we are on the same batch. Let's just trade directly with each other without going through the AMM. And the net amount is then settled on an AMM, okay? And the important part is that everybody on the batch is trading at the same price, modulo some fees if you want to have fee, okay? So there is a uniform clearing prices on the batch because everybody faces the same price. And this specific AMM can be accessed only via the batch. Now, importantly, from the point of view of the designer of the AMM, if you know that anyway, that you have a mechanism to batch trade, so you have a mechanism to enforce that all trades on the batch are in the end executed at the same price, you do not have to worry about path independence anymore, right? So the AMM itself doesn't have to worry about path independence because there is external mechanism that are going to make sure that it's not profitable to split trade, okay? Why would you split trade? Anyway, if you end up on the same batch, you're going to face all of the same price. Now then, essentially, this opens up the mechanism design space where you can say, okay, well, I can think about other type of AMMs. And in particular, what we propose here is a function maximizing automated market maker. So an AMM that every time trades, so to maximize the product of the function, if you want, what should be an invariant function, but here you actually maximize it. So I will discuss in a second. And then we have a theoretical model, which is the main contribution of the paper, where essentially we take this design and we place it in a model which is very similar to the initial example I had. There is the AMM, there is Binance, there are Arbitrageurs, prices change, what happened there. And I'm going to argue that if you have enough Arbitrageurs and sufficient competition between Arbitrageurs, then the equilibrium is going to be that the FMAMM always trades at the Binance price modulo some latency. Okay, but then what does it mean? This means that arbitrage profit LVR is eliminated because the AMM always trades at the correct price. And also sandwich attacks are eliminated because essentially everybody on the batch trades at the price which is that of Binance. So it's exogenously determined. So attacker cannot create this short-term variation in prices that they can use to exploit their victims. And then we have an empirical analysis where we look at price data from 2023, because that's kind of, we did this analysis at the beginning of 2024, where we compare the return of providing liquidity to Uniswap v3. These are empirically computed by looking on-chain data, to a simulated FMAMM where there are no noise traders. So the FMAMM, that all it does is rebalance at the correct Binance price by Arbitrageurs. And I'm going to show you obviously the details, but the takeaway is that the two returns are very similar. Okay, they're kind of quite in line, which the takeaway will be that if you then have noise traders on an FAMM and the FAMM also earns trading fees, then you should have a better mechanism than Uniswap v3, which is currently the AMM with most liquidity. Okay, now for the theoretical model, we're going to think about function maximizing AMM with product function as a price-taking agent. This should look to you like really micro, the first year micro PhD, okay? This is just an agent that is price-taking, has an objective function. You can think about it as a utility function, but of course, in this context, that's not how it's called, okay? And its objective is to maximize the product of its liquidity reserves. And formally, this is the problem that the AMM is trying to solve. So you give him a price, and therefore it maximizes the product of the liquidity reserves. And this gives rise to a demand function. Demand function that says, okay, if the price is this, the AMM wants to trade this much. Now, you can invert this function, meaning you can ask yourself, okay, if this is what the AMM wants to do, if I want to trade with the AMM and I have a certain amount that I want to trade, what price should I announce to the AMM so that it actually wants to trade the amount that I want to trade, which amounts to just inverting this function to get a pricing function, which is this, we now get more into the real AMMs, that says at which price the AMM wants to trade for any given amount, small x, given the state of its liquidity reserves. Now, I don't know if you remember, but the standard constant product AMM, I had the pricing function, and the only difference with what is here on my slides was these two. So if I remove these two, this is the pricing function of a constant product AMM. Now I've derived it differently, so it's a different object, and it turns out that mathematically the only difference is that now we have these two, which might look like a small difference, but it turns out that is fairly meaningful. Because now, because of that too, the function maximizing AMM doesn't stay on the curve anymore, but in fact moves up the curve each time. And this is a bit like a graphical representation of how the AMM behaves, right? This is the AMM trade, the AMM pricing function is an outcome of an optimization problem where the objective is to stay as high as possible on the curve, like call it an indifference curve. Obviously, there is a strong analogy to that. And then, sorry. I knew this was going to happen. So then, of course, you move up the curve with each trade instead of staying on the same curve. Now, the function maximizing AMM is clearing price consistent, where the definition is that the price at which the AMM trades equals the marginal price after the trade, okay? So for example, here, the AMM traded at the price P of X. It turns out that this is also equal to the tangency of the new curve after the trade, so that if you want to do another epsilon trade with the AMM, you will still pay P of X, right? So again, here is a situation where I come in, I do a large trade, I pay a given price. And if someone comes after me and does another epsilon trade, also pays the same price, unlike a constant product AMM. Yes?
So can I ask a question?
Sure.
So what is the meaning of the curve if you're not staying on the curve? So you are at a particular point. This is not a curve, it's a point. And then when a trade occurs, you move to a different point on a different curve. So it's not really a curve.
It's I mean, there are level curves if you want. So
what does the curve represent? It's not the way the price will be adjusted when trades happen, because you would move to a different curve.
Every time the price move, there is a price change and the AMM trades, it moves to a higher curve each time.
So I'm trying to understand why is it
and
a
if
curve?
you choose another curve, this it behaves differently. So why? Okay, it turns out this has nice property, and I can explain in a bit what those properties are.
Okay, so one more question just to understand the mechanism. So you defined a different AMM function target, this AMM.
Yes.
If I don't go through the order matching process first, and I just do the blockchain thing, I submit my trade and it happens. Does it work? Does the FAM?
No, it doesn't work. And this is actually, it's an excellent, you anticipated my next point, because this pricing function, so the FAMM in general, violates path independence, and it can be exploited by splitting trades. And in particular, if you split the trades in epsilon chunks, you are back to a constant product AMM. So you are back to moving along the curve. And okay, here is, for all those of you that are graduate students in economics, I can finally bring out my favorite intuition for why this is the case, because usually I present to computer scientists or finance scholars. And my favorite intuition is the envelope theorem, right? The envelope theorem says that when you are maximizing, you're doing a maximization problem, and one of the parameter changes, if you don't re-optimize, if you don't change your argmax, really there is no first order effect, okay? Meaning you're already at the maximum and something moves. Even if you forget about re-optimizing, you don't have any first order effect, you might have second order effects. Now, why is this the right intuition? Because essentially the AMM, when you do an epsilon trade, the AMM should move up the curve, but in fact, in a constant product AMM, is going to stay on the same curve. But the difference between the two is going to be second order, because it's the difference between redoing the full optimization problem or kind of fixing one parameter and stay on the same level curve. So then you have, if you do many epsilon trades, you are essentially moving along the curve. So this whole new mechanism only works if you really have this batching part where you prevent trade splitting, because no matter what's happened, there is always going to be a single trade reaching the AMM in each block. Which goes back to, like, this is the reverse of what I was saying earlier. Because I can batch, I have a larger design space. And now I have this design and I can show you that I need to batch. Okay. And in the theoretical model, which, really, okay, this is really built around the example I was giving earlier with a little bit more nuances, but it's really just the same. So the idea is that there is this FAMM and there is a large off-chain trading venue where the equilibrium price is P star. There are noise traders trading on the FAMM, and those guys are just noise traders typically are people that want to trade for reasons that have nothing to do with the price, or like they're not strategic, let's put it this way. So in the model, you just say, okay, in a given block, there is so much volume, so from noise traders. And then instead there are price taking arbitrageurs that can trade both on this external trading venue, say Binance, and on FAMM, and their goal is to trade so they maximize profits. And okay, so it's also not completely obvious how to think about time in the context of blockchain, because there are blocks have transactions, things like that. And the way we think about it in the model is saying, okay, time is discrete, and there's going to be even periods that correspond to blocks, and this is where the on-chain transaction occur. And then there are odd periods where instead there are all the off-chain events. And in odd period, the equilibrium price on this external trading venue might change. And in the odd period, also traders submit orders for inclusion in the batch that then will be executed in the following even period. Yes, there is no, sorry, I think this is actually incorrect. The FAMM might charge fees, sorry, also for inclusion in a batch. Sorry, this is incorrect. Apologies. I don't know why this is from a. So if I might charge fee, okay, but enough. Okay, we can forget about fees for the moment, given that I am like 10 minutes or not even to finish my slide. Let's say there are no fees. The model actually has all the fees in the paper. And this is the main proposition that says that arbitrageurs compete. So essentially, the proposition says that in equilibrium, there cannot be an arbitrage opportunity that is left unexploited, because you have this large number of identical competing arbitrageurs that all of them can submit trades on Binance, all of them can submit trades on the FAMM. So there is no equilibrium where they can make additional profit and they don't do it. Okay. Obviously, if you want to bring in gas cost and other thing, there will be additional nuances to this proposition, but in the absence of any other cost than the AMM trading fee, you cannot have arbitrage opportunity left unexploited. But then this means that traders are going to submit trades to the AMM batch until the price of function maximizing AMM is equal to that on Binance. Note that, however, on the batch, everybody pays the same price, meaning that everybody who's trading with a function maximizing AMM will then pay the Binance price. Okay. So the arbitrageur, important thing is that the arbitrageur here moves the price not just for himself, but also for everybody else on the batch, because everybody on the batch pays the same price. Okay, so this means no losses to arbitrageurs. In equilibrium, they make zero profit. Again, you can add additional nuances if arbitrageurs are not heterogeneous, if there are additional costs. But the point is that you are exploiting competition between arbitrageurs to get as close as possible in the simple model to get exactly at the Binance price. And also no sandwich attack, because the AMM always trade, everybody on the AMM always trade at the Binance price. So the price is determined exogenously for everybody on the AMM. Okay, so okay, fees again, forget about it for a second. Yeah, okay, this is not so central. Okay, now empirical analysis. Now we try to estimate what would be the benefit of having such a mechanism, comparing it to Uniswap v3. Now, the problem with Uniswap v3 is that, so the one hand is a natural benchmark because it is the largest AMM, okay? The problem, however, is that when you put more, liquidity on a Uniswap v3, you choose a range. So you say, my liquidity should be available only between this price and this price. And also, bit of the name of the game of providing liquidity on Uniswap v3 is also changing where you place your liquidity to maximize the fee that you earn, but minimize the lever that you face. So it's not completely obvious what is the benchmark. But what we do here is instead looking at Uniswap v3 and considering an unconcentrated liquidity position. So a liquidity position that covers the entire spectrum of prices. Okay. We do that for several Uniswap v3 pools. So essentially, we go through the list of pools by trading volume, and we choose the top one. excluding stablecoin pairs and also excluding tokens not traded on Binance, because in the empirical we need the baseline prices to compute these theoretical arbitrage trades. We are left with like high volume pools which involve WETH and BTC exchange with each other of some stable coins, and also some low volume pools which are a bit more random tokens. Now we simulate the return on an unconcentrated liquidity position on Uniswap v3. So essentially we say, okay, suppose that someone put a certain amount of money as this unconcentrated liquidity position. Then we can look block by block the trading fees that the pool earned. We can look at the amount of liquidity around the price at which the AMM traded. And then we can say, well, okay, if there was so much liquidity around the price and we hypothesized our position that ends up being like a certain percentage of the total liquidity around the range in range, then we can impute how much of what the percentage of the trading fee that our position would have earned had it existed, because this is hypothetical. Sorry, this wasn't maybe super well said. But by looking at the total distribution of liquidity and the fee earned by the AMM, we can compute what percentage of those fees we would have earned had we really set up such a kind of a small unconcentrated liquidity on those pools. And this is our benchmark. And then we use the Binance price in the theoretical model to simulate how Arbitrageurs would have rebalanced our function maximizing AMM with no noise traders, okay? And the assumption is going to be that the function maximizing AMM also charges the same trading fee as the corresponding Uniswap v3 pool. So the function maximizing AMM essentially here, because there are no traders, no noise traders, just Arbitrageurs, the only benefit is that it doesn't suffer lever, okay, but it has no trading fees. Whereas instead, the Uniswap v3 pool, these are the empirical data, you have both lever and trading fees. Okay, but then when you compare the two, another way to see this empirical exercise is to try to see whether lever is larger or smaller than trading fees, because Uniswap has both lever and trading fee. FAMM has only lever, so no lever, and then you compare the two. All right, and these are the results. Oh, sorry, this maybe didn't come out too well, the graph, but positive here means function maximizing AMM is better. Okay, negative will be Uniswap has a higher return. And this is for the high volume pool that for the most, they seem to indicate the function maximizing AMM is better. Again, function maximizing AMM without trading fees, meaning it's simply saying that therefore on a Uniswap pool, lever exceeds trading fee. Okay, so if you remove lever and you remove trading fees, you get better than the empirical returns, with that exception that is this WETH USDT pool, which is anyway kind of very, very small difference. All right. And again, I don't want to make a big fuss of the fact that, you know, function maximizing AMM is better. I think the takeaway here is the two are very similar. So there is no really just a big difference, because we are looking at like 0.1% difference. And so the takeaway is more that if an FAM and MM were earning also fee, probably there we will have a more significant difference between the two designs. And then this is instead a result for the low volume pools. It's a bit more all over the place. Numbers are bigger, and also the like positive, negative, you can have both. In particular, this Matic WETH pool, Uniswap pool seems to outperform by quite a bit the function maximizing AMM. And here we have some calculation showing that for the function maximizing AMM to generate the same return as this specific Uniswap pool, it will need half of the noise trading volume that this Uniswap pool received. So then if it is at least half, a function maximizing AMM will outperform. But zero trading fee, it underperforms the Uniswap benchmark. Right, okay, so this allows me to conclude. Okay. I think the takeaway is that batching, which is something discussed in the literature about traditional financial market, can be used also to construct these novel AMMs that eliminate arbitrage profit and also sandwich attack. And in some sense, the benefit of those things, these new designs seems to be confirmed by our empirical analysis that again was limited as this very strong assumption that our simulated FM AMM didn't receive any noise traders, so had no fees, earned no fees from noise traders. And of course, we speculate that a function maximized AMM that also earns fees from noise trader should perform better than the Uniswap v3 pool. By the way, we worked with Uniswap v3 because we thought it was a natural benchmark. Yeah, so it is because there's the AMM with most liquidity. We then did another research paper with Robin, where we compared the return from liquidity provision between Uniswap v3 and Uniswap v2. And it turns out that LPing on Uniswap v2, as if you want to do this kind of unconcentrated buy and hold type of strategy, is actually better on Uniswap v2 than on Uniswap v3. So maybe with hindsight, we should have done the study with Uniswap v2 because we find that it is actually better than Uniswap v3. Okay, but on the other hand, Uniswap v2 is the market leader, so it makes more sense to do it this way. Oh, finally, so just a couple of words on the literature. Yeah, as I said, this paper is heavily inspired by the literature studying batching in traditional financial market. That will be this one. There is a literature on sandwich attack. There is a literature on arbitrage profit, LVR, or various ways in which arbitrageurs can exploit liquidity provider in the context of AMMs. Let me also just say that, in a sense, the FMAMM or some version of FAMM already popped up in the literature, either the pricing function, the idea that this was implementable only by batching. Nobody really noticed that this is equivalent to a function, to a maximization optimization problem. Anyway, some version of this came out already in the literature, but nobody noticed that design can solve a lever and eliminate arbitrage profit and sandwich attack. So I think the contribution is really showing that design in a theoretical model where you have arbitrageur and a bigger trading venue, whatever, has very appealing properties. But the design itself came out from in some places before. And of course, also mentioning that this kind of AMM that capture MEV, capture lever, there is also a lot of discussion, not in research paper, but in blog post. And that also was also quite relevant for the writing on the paper. Okay, then specific which blog post is in the paper we discuss. All right, thank you.